In the game of buying bricks and mortar, some properties are a safer bet than others. And banks want to make sure that your property selection meets their criteria. G'day, I'm Aaron Christie David, mortgage broker and founder of Atelier Wealth. I specialize in helping Australian families start out and scale up their investment property portfolios. According to the Australian Bureau of Statistics, there are 10.6 million dwellings across our beautiful country. 2/3 of these properties belong to homeowners, while the remaining 33% belong to property investors. That's 2.6 million investment properties. With so many properties to choose from, it can be quite tricky to decipher what makes a good decision compared to what makes a great decision. There's a great phrase coined by the guys at the Property Couch: investment stock versus investment grade. And besides wanting to invest in a successful property, there are two other important reasons to distinguish between these properties. One, it can limit which banks will lend you money. And two, it can limit your future potential buyer for this property, which in turn can restrict your capital growth prospects. So, I wanted to break this down and give you insights into what properties the banks feel are not investment worthy. But before I do that, I just want to preface that this video is general in nature and not intended to give advice. I always suggest chatting to a qualified mortgage broker who can give you the best guidance for your situation. All right, so think of it this way. It's in the bank's best interest to make sure your property won't fail. So they have a long list of their own criteria to assess what properties they would be willing to lend you money for. This means that if you're looking to spot a winner from a dud, one of the first places you should look at is the bank. So let's go through the 4 criteria banks apply to determine if they will lend on your potential investment property. The first is location. There are a couple of things that banks will consider red flags. For example, flood-prone or bushfire areas are restricted. Banks also tend to prefer to stay away from mining suburbs or some holiday destinations. High-density areas are also not a firm favourite, especially where there have been many unit developments. In this case, banks will actually have a maximum loan-to-value ratio, or they will limit their lending within a specific development. You may also have to consider demographic issues like high crime or high unemployment. And if your property is located too close to a transmission line or a train station, you'll definitely be required to stump up at least a 20% deposit. So that's location. Next, you have to consider the type of property. And I'm talking about specific properties like student accommodation, service apartments, or dual key properties. Banks aren't huge fans. They also don't love company titled properties or properties deemed as commercial properties like boarding houses or more than 2 units on one title. The next thing banks consider is the actual property itself. Some banks will restrict lending if the property is too small. For example, studio apartments under 50 square meters will need at least a 20% deposit, and only a handful of lenders will consider these. In the same breath, they're also not huge fans of properties that are too big. Some properties over 50 hectares present a risk. And if the properties are renovator's delight, but is not livable or the build is not compliant, that is another hurdle. Cladding on apartment buildings has also become a focus for a number of lenders too, especially if it's not up to code. The last criteria that banks or lenders assess is the classification of the property. The classification could range anywhere from its zoning or the category of the property. For example, only specific banks will give you a loan for NDIS, NRAS, or defence housing properties. While display homes get great rentals for a period, again, only limited banks offer funding for this type of property and often have very specific loan-to-value ratio policies. Other properties you have to keep an eye on which might raise red flags with the banks are properties with planning restrictions or specific types of zoned properties. Off-grid properties are also not the most favorable. The allure for many investors when they are looking at these types of properties that fall into one of the four categories is they typically get excellent rental yields. So while the cash flow is great, if this investment isn't supported by capital growth, you're going to have to jump through hoops to refinance it to access the equity, and you will limit which banks you can potentially go to. Remember, lenders are looking to minimize their risk. They aren't concerned about your wealth building efforts. So the ugly truth is they're always going to think about what would happen if they had to repossess your property. Can they sell it quickly enough to get their money back? So when you're hunting for your next investment property, think like a bank. This way you can narrow down your search to properties that you're very likely to get funding for. Anyway, hope you found this video helpful. If you did, make sure to like and subscribe for more property investment tips. We'll see you next time.